Oliver, we've had a load of first quarter results from a lot of banks today and in the last few days, and they're not telling us, I think, a lot of very good news about the banking sector. Despite the fact that, other companies, other sectors are doing a bit better, banking is still really, really in trouble.
It is still very tough for the banks. What's happened is a lot of these banks have actually beaten expectations, so share prices have actually done quite well, but the numbers themselves are not encouraging. If you look at the very top line income, sort of fee income, interest income, that kind of thing, it's flat or falling for a lot of the banks, particularly those for whom most of their operations in Europe, they're struggling to get any more income in. Even for HSBC, big international bank, big global reach, even they're struggling to get much growth out of the global economy.
Yeah, and I mean, what are they doing to counter this? I mean, it's all very well cost cutting, but I guess they just need to keep doing that.
Yeah, they need to keep doing it, and they're going to be doing it even more. All of the banks that have reported today have been cost-cutting to some extent. Some of them, such as Societe Generale, have increased their cost-cutting target. SocGen's doubled its cost-cutting target by 2015. Others are taking right down for job cuts. We'll hear next week from HSBC on its next sort of cost-cutting plan. So it's coming down across the board. But you have to ask at some stage, does this damage their ability to generate revenues if the economy starts coming back? Now, all the banks say no, it doesn't. What they're cutting is back office costs, system costs, IT costs, that kind of thing, and the revenue generating capacity hasn't been reduced at all. But at some stage, if you keep pulling your costs back, it's going to affect the amount of revenues you can generate.
But I wonder whether given the sort of accumulating woes of the banking sector, we all know what they are. I mean, they're regulatory as much as they're sort of operating. Whether there's any one big thing that the banks can do individually to sort of counter the downturn, to counter the underperformance, to get their sort of book value ratios back up to sort of decent multiples where they should be.
Well, the only thing they can do is be ever more radical. I mean, what we've seen from a lot of banks is kind of little bits of incremental cost cutting just to try and keep the cost to income ratios at least stable. But the big change really has been at UBS. It's a good example of it. They've radically cut the size of the investment bank and cut their trading activities, and that's had a big impact on the share price. So I think if banks really want a short-term share price jump, that it's a more radical reshaping that's necessary.
Okay, well, we've seen the numbers over the last few days. They're not making for great reading, but I guess the banks will just have to carry on and continue the cost cutting and continue the restructuring. Thanks, Oliver.